From the morning reading, SPX breaks support on Fed minutes reaction, recovers at close, at support in the last hour. Netflix surges. All 9 sectors moved lower on Wednesday. XLU, XLP, and XLV were the strongest sectors for the second straight day, while XLE was the weakest sector. Breath wakened as decliners led advances 2.87 to 1 on the New York Stock Exchange and 2.43 to 1 on the NASDAQ. Global stocks resumed selling. U.S. stock rally has been too narrow and vulnerable to a downside correction. Gap between small and large caps is a warning sign. So is the drop to 40% in the New York Stock Exchange bullish percent index. The percent of New York Stock Exchange stocks above the 200-day moving average is below 30%. Wilshire 5000 better reflects market weakness. Small caps are leading, large caps lower. Global stocks have started the year on a bad note. Most of that is being blamed on China. A plunge in Chinese stocks and a drop in the Chinese yuan to a 5-year low are certainly causing a lot of worries in global markets. But there's more than that going on. That's especially true in the U.S. It's been pointed out, for example, that the fourth quarter rally in the U.S. was primarily a large cap rally and that smaller stocks have been lagging too far behind. In addition, it's been mentioned that several measures of market breadth have not been keeping pace with large cap stock indices. All of that has left the U.S. market vulnerable to a setback. Nearly 3/4 of stocks are below the 200-day averages. The stock market is a market of stocks. A bull market can only exist when most stocks are in uptrends. That is not the case right now. Foreign shares are starting to weigh on the U.S. Another warning sign for U.S. stocks is the growing divergence between them and foreign shares. Generally speaking, a positive correlation usually exists among global stocks. A healthy bull market usually requires that most global stocks are rising together. That is not the case now. The past year has seen a multi-year high, a deep correction, rebound, and now another multi-month low. Going back to 1928, there have been 12 other dates that have had a high correlation to this trading activity. Those dates led to mostly positive returns going forward, particularly with the dates that had the highest correlation to the past year, which also happened to be the most recent ones. Despite the S&P 500 falling to a new 50-day low, the VIX fear gauge is still well below its 50-day high. Typically, the two move in closer inverse way. The other times we've seen this relatively muted VIX, stocks tended to rally in the short term, with a caveat that this was also seen early in the last 2 bear markets. Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:58 a.m. Central Time, and I'm recording this in preparation for the market day of January the 7th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, another big night, and indeed, China lock limited down. The market in China was only open for about 30 minutes, and it hit its lock limit down at 7%. And that, of course, has had an impact on all the rest of the markets. And you'll see at the time of this cut, the S&P futures were down about 44 points, or over 2%, about 2.25%. Russell futures down about 2.33%. NASDAQ futures getting hit the hardest, almost 3% down. Dow futures down about 2.25%. Crude oil down over 4%, down almost $1.50. The euro is up about 0.2%. Bonds are up about 0.4%, and gold is up almost 0.6%. And other overseas action, Hong Kong also down sharply, down over 3%. Japan down well over 2%. Germany 3.5%. That's probably our biggest predictor for our market. And the United Kingdom down nearly 3%. In terms of macroeconomic reports for today in the US, you have the weekly variety of the unemployment claims and nat gas storage. For those that trade those futures, you want to pay attention to that. In terms of the Friday and the upcoming, we have the monthly employment report. And this is one of the big four, so that one will definitely play a big role in what happens pre-market tomorrow morning. Once the market opens, just a couple yellow flag reports, nothing too significant after that. In terms of current volatility conditions, as you heard in the morning reading, it's been a little bit interesting in that as big as the down move has been in recent trading sessions, there's not been that much fear priced into the market. You see the short-term VIX at a 20.6 that is elevated, but nowhere near to the proportion that our markets are down. Skews also quite elevated, and it's been predicting another 2 standard deviation move to the downside with much higher probabilities, and that would certainly seem to be coming true once again. IV percentiles, 33 for the SPX, Russell 31, NASDAQ 32, and Dow 33. Again, you see the fear premium, the market maker moves, these kinds of measures just really aren't that elevated, while at the same time price has certainly been elevated, and we've now got 7 of the last 10 trading sessions in the S&P that have had a standard deviation move, and certainly today would look to be piling on to that recent trend. This is really unusual. We normally have about 2 a week of a 1 standard deviation move, and right now we're running about twice that pattern. In terms of the charts, let's take a quick look at that. I've gone to the futures because of the overnight action being so significant. And indeed, notice I put on a fib extension here from the most significant swing low to the swing high. And we blew through not just the 50%, but now in the overnight action last night, the 61.8 fib extension blew through that. We'll want to see what happens when the cash market open and all the market participants come back together. But normally the expectation is when you go and confirm through the 618 extension, you likely are going all the way to the 100. So you need to take that into account as you're reviewing your portfolio and the amount of risk that you have on in your portfolio, both individual positions and collectively, that this could, with some enhanced probabilities, go all the way down to this 1860 area before it finds a bottom. And are you prepared for that? If you're not prepared for that, then you certainly have had plenty of warning. We've been increasing the hedge risk level, all along through this action. You've gone from a 1 to a 2 to a 2 plus, and now to a 3. And you certainly have seen escalating probabilities of these kinds of down moves. So this is not a surprise at all. And you've had plenty of opportunity to make adjustments. In terms of the others, let's take a look at the Dow. Again, total breakdown. It's going to be the theme with all these, of course. NASDAQ, very ugly. And NASDAQ is broken down worse than the others. It makes some sense. Obviously, NASDAQ tends to be the higher beta, the more tech-oriented, less dividend-producing. Those tech stocks are often the first ones to get hammered when the market truly goes down. And then, of course, the Russell total breakdown. This has gone down now past the August lows. So, wow. And we're going to have to go back a little bit to see where the next level of significant support would be. It would look like down here around 1037 is the next significant area of support. The Russell broke down through the double bottom of the recent lows in August and in September. So we'll see what market, if this just becomes a whiplash, and if the cash participants are able to promptly reverse this and it just becomes another in the area type bottom. But if that doesn't happen pretty quickly after the market open, especially within the first 15 to 30 minutes probably, and this starts to build down, it's probably going all the way down to 1039. If that happens, it certainly doesn't help the other markets that we don't normally think of the Russell as the one that leads the indices, but in down markets, the small caps are often, the leader. So we'll certainly be watching the Russell. We'll be watching the Nasdaq, and we'll be watching the commodity complex. The commodity complex is also an awful lot of this recent story, and you see on crude oil, as in the crude oil futures are now down to 32 and change, and really are starting to threaten the 31 handle. So very, very, very ugly action in the commodity complex, and we could be talking 20s in the not too distant future. So significant breakdowns in the commodity complex. In terms of the VIX futures, you see we popped up to over 23. Again, these are elevated levels. Anything over 18 is not the land of the bulls. But when you're only, and I say only, a 23 and a 22, or kind of right now about 22 and change, that is not, the kind of action that you see normally. You look back here at the August breakdown, you see it went all the way up to over 30. And it did that in 1, 2, 3, 4, relatively few, trading sessions. This has been quite a muted response. So we'll see, as if the morning reading implies. One of the authors suggested that oftentimes when you have such a muted response in the VIX, that you start looking for a short-term rally. So we'll see if we start to see signs of bottoming coming in. And then bonds. Also, bonds, while going up, certainly has been relatively muted. It's certainly not broken out through its recent highs yet. In fact, it's really just still inside the consolidation pattern, though up towards the upper part of its recent range. So nothing particularly exciting from volatility or from bonds to say that this is something to be terribly fearful of, while at the same time it would seem that the price action on the actual indices and on crude oil are all quite ugly. Let's go ahead and go to the daily report, and this is, as you would expect, quite ugly. We are full out phase 5, break of horizontal diagonal support. Marketing correction, accumulation distribution has deteriorated all the way down to an E on the S&P and the Nasdaq. That's, I think, is worse, the worst it can get. The GMI index, also the worst it can get, is 0 out of 6. And then also stock charts decision points. Notice that we've had further deterioration here, and then now starting to bleed over into intermediate term on the S&P 100 and on the Dow. Intermediate term now turning more decidedly neutral, with 3 of the 4 signals on the trend model turning to neutral. So very, very ugly on the short term. Now getting mixed signals on the intermediate term. We already had mixed signals on the long term. While this can certainly get much uglier and we can get lots of red arrows across all these time frames, this is the worst we've seen this in quite some time. In terms of that intermediate term market posture, very bearish, also a bearish sentiment line. So the expectation is that bear moves are longer and more pronounced, and bullish moves are counter trend. In terms of position sizing, as you would expect, quite defensive. Portfolio investor position sizing opinion currently at 0%. Volatility base is currently at 50%. If we bleed up over 24 with a close, this will drop to 50% on that model as well. In terms of the individual indices on that intermediate term market posture, you can see very bearish on 3 of the 4 indices. The Russell in the severely bearish camp, but it does have a bullish cluster formation present. So we may be setting up for a bounce in the relatively short term on the Russell. We'll want to keep an eye on that. We talked about that from the charts. In terms of hedge warning status, this is a full out threshold level 3. This means that this is the highest that we go. That's a crash warning level, and conditions are present to have a significant downward move. This is not a prediction of a significant downward move, nor a prediction of how far that move will go, but rather it says that the conditions are present, that these kinds of probabilities are greatly enhanced. Now, the reason for that kind of clever twist of words there is that oftentimes in bull markets, and we have certainly seen this on a very frequent basis in the last 18 months, is that just when things seem most scary and you are coming down into range bottoms, the bulls step in and then reverse it, and then it seems like 3 days later you're right back to where you started from. And you've got to understand what hedge warning status is about. It's about an opinion about increased warning and probabilities of a breakdown, full out breakdown in this case, with a hedge threshold level 3. We have to remain very aware that at these points, this is when oftentimes you get reversals. So it's not just an easy thing to just load up with a bunch of long puts or other hedges and then just walk away from the screen. If you do that, you could find that your hedges become the source of your problem. It's very important that you're very nimble if you're going to engage active hedges or active bearish swing trades. We are not yet in a full out bear market. We have not stacked the various time frames into an intermediate or long-term status of a bear market. Far from it yet. We certainly are a market in transition, and it is yet to be determined whether this market is going to break down or up from what is ultimately a very large range. And that range, for example, on the S&P futures, going from the 1830 areas where you were at the bottom of your August lows all the way up to 2100 areas. So some 200-point range, or about a 10% move between the upper and lower, just between what's happened in, say, the last 7 months. So that's a big range, and yet at the same time, all the price action between those two extremes is pretty much within a range, a large range at that, but still within a range. So until we actually break one side or the other of that action, it's going to be very difficult to say that you're actually in a healthy bull market or in a straight up bear market, and not just bouncing between these two extremes. So a lot of language there. Hopefully you understand where this is going, but clearly conditions are quite elevated and need to remain quite ready with your portfolio management as a result. As you would expect, a sea of red in terms of our individual warning indicators: market in decline, sharp increase warning, distribution day counts, and the market in correction. VIX futures well up over 18. VIX face has been increasing. Skew is elevated. You have well over twice the number needed for a warning status on the New York Stock Exchange, with 701 new lows put in for the month yesterday. In terms of risk aversion indicators, 4 of the 5 are flagging as risk off. Fear and greed is now down to a 35. And then, of course, I won't go into a lot of detail on this today, but the special opinions, option income strategies, cover call strategies, put selling, all 3 of these outside acceptable windows to initiate new positions. You were far, far better off to manage existing positions and to watch your watch list for signs of bottoming and preparing yourself for what you might do when that bottom starts to come in play. But in terms of initiating any new positions in the face of this, that would not be recommended in any way. In terms of sector specific, a sea of red here, only utilities holding up. Also a sea of red on the percent change, and notice that that percent change now 1 day, 5 day, 1 month, and starting to bleed into the 3 month, which is off the the last correction. So those comparisons from 3 months ago are generally fairly healthy. So if you're now starting to look at falling below those correction levels, that's not a great comparison. So a sea of red here from this report, top to bottom, hedge warning status 3. Be prepared to take portfolio risk management steps in the face of this. So I think that's more than enough for today. A very important report. And if you find that this is helpful to your trading, we would ask that you like us on YouTube, we retweet us to your Twitter followers, to your StockTwit followers. Frankly, it is in these kinds of conditions that we see spikes in the viewership and subscription activity. And if you've got trader buddies that you think would benefit from this kind of morning analysis, we certainly welcome you spreading the word to this free morning market preview. Subscription to the YouTube channel is also free, and by subscribing to the YouTube channel, that also allows you to get basically a heads up that new content has been published. Okay, that's enough for today. And I'd say good trading, perhaps the best thing you can do with good trading is manage your risk and then review your watch list, and we'll go from there.